back. You are listening to TurboCharge Your Business on the #1 global business talk and news network on the internet, IBGR, International Business Growth Radio. I'm Patty Lawrence, and this is episode 34, Cash Flow versus Profit, Defining the Differences. Be sure to go to our website at ibgr.network and download the show notes. So, we talked a little bit about cash flow versus profit and what the definition is. So definition is with profit, you're looking at revenues less your expenses. And with cash flow, you're looking at all of the movements of money in and out of your business. So what are some of the specific differences that we look at as financial people or business owners? Well, some of those, first off, I should say, we can say definitively, based on what we have already talked about, that cash is not profit and profit is not cash. So either way, we are talking about two separate things, two completely different things. And statement of fact, a company can show a profit, be profitable on your income statement and still lack cash, right? Because we talked about those types of requirements, cash requirements for your business that don't necessarily show up on your profit in your profit and loss statement. So we can say that you need both profit and cash flow, positive cash flow in your business in order to succeed, right? In order to be a successful business and grow, those are the things that we need to have. So, what are some of the things that show up as profit and maybe not so much as cash? Well, we have some, we'll call them non-cash type items that run through our profit and loss statement. Specifically, depreciation, specifically amortization. Now, those are some big words. And what they are, they're really non-cash items because they are basically recognizing the useful life of an asset over time. So maybe we paid for an asset or we're paying for an asset over time. But what runs through our profit and loss statement, generating a profit or loss, is depreciation, which is non-cash. The cash that's expended to acquire the asset is done at a point in time, and then that asset goes on your balance sheet. And we talked about financial statements in a previous segment, that those items that go on the balance sheet stay there. They're from the inception of your business. And those items, say it's a vehicle. So that vehicle, the full value of the vehicle goes onto your balance sheet. But then what we're saying is in the profit and loss statement, we're going to recognize a portion of that depreciation of that asset over the useful life of the asset. So say that vehicle has a useful life of 5 years. We will take 1/5, roughly, if it's straight line depreciation. We'll take 1/5 of the value of that into account, into our P&L as an expense in the first year, and the second year, and the third year, and the fourth year, and the fifth year. And by the end of year 5, that vehicle will have been fully depreciated on our balance sheet. Yet each year we will only recognize expense depreciation expense related to 1/5 of the value of that asset. So that is one big difference between cash flow and our profit because of depreciation. The same goes with amortization. Amortization is very similar in that you're getting an intangible asset. Say you bought a business and you've got to depreciate the value over time. Depreciate maybe goodwill, or maybe you've got patents, certain other IP in your business, and you're going to depreciate that over time because maybe it's technology based, and technology over time, gets, I guess, gets replaced, if you will, or goes out of date. And that we have to recognize that over a period of time. That's good accounting. So, what else? Where are some other differences in our balance sheet versus P&L, which is cash flow versus um, a cash flow versus our profit? Well, think of loans, right? So, say you did buy a vehicle, you put that vehicle on your balance sheet, but you only made a down payment on it. So maybe it was a $30,000 vehicle and you paid down $10,000. So you had cash flowing out of your business, cash flow out of your business of $10,000. None of that was on your profit and loss statement. Zero of that was on your profit and loss statement. So where does it show up? Well, maybe you have a loan for the $20,000, the balance $20,000. That's still on the balance sheet. You may pay interest on the loan, and now that's going to go onto the P&L, right? That's interest expense. But the actual payment of your loan payment is a cash flow item, is not a P&L item, not a profit and loss type of thing. Does that make sense? Hopefully it does. So those are some of the major differences as it relates to cash flow versus profit. Now, we can also look at some of the types of cash flow that we have for our business. Some of this is from operating activities. So if you think about, your revenue minus your expenses and you get a profit, that profit, goes to fund some of your activities, right? Some of your loan payments and things like that. So that's cash from operations. That's operating cash. You can also have cash from investing activities. And when you say investments, what kind of investments are we doing in our company? Well, these are like long-term asset investments. Think of property, plant, and equipment in your business if you have that type of business. So if you're buying equipment for your business, or you're buying acquisition, as an acquisition of a business, that will go into that as well, because you're investing in your business, investing in fixed assets, you're investing in equipment, you're investing in property, furniture and fixtures in your inside your business. The last type of cash flow there is in your company is usually reserved for larger companies, but smaller companies may have it as well. And it's called cash flow from financing activities. Financing activities are generally issuance of equity or debt, and the repayment of each of those. And if you have payout for dividends, or you pay out let's say distributions, owner distributions. That's an equity type of transaction. So those types of transactions are categorized as financing. So if you think about overall financing of the company, you have that. Also, we talked a little bit earlier about vehicles being financed. So if you get a loan, a vehicle loan, for a smaller company, that's what that type of activity would be, because the company is buying, or the financing company is allowing you to pay back over time for that asset purchase. But the seller of that vehicle got paid. They're like, whoop, we got paid. Here you go. Here's your vehicle because you have a loan and you put money down. So the money down came off out of your accounts, out of your operating cash. The rest of it is being financed and will be accounted for that way. So those are some of the differences between cash flow items and profit items in your business. We're going to take a short 2-minute break. And when we return, we'll be talking about cash flow versus profit, end of year tax maneuvers. Be sure to check out my collection of free resources at turboexecs.com/turbocharge. And you can continue the conversation with me, Patty Lawrence, on LinkedIn. You have been listening to Turbocharge Your Business and episode 34, Cash Flow versus Profit, Defining the Differences, on IBGR. I'm Patty Lawrence, and we'll be back after a short break.